All right, I got the volume all the way up. How's that, Morgan? Are we good? And I will move it even closer to me so you can hear my sexy voice. Oh, yeah. Guys, thank you for coming. I appreciate your time here today. Thank you for the last speaker. There were some pretty good things shared there. If I have some time, I want to add to some of the things that you heard today about risk management, percentage per trade, things like that. But I'm going to spend the bulk of the time doing what I said I was going to do. Able to make his screen fill full frame. Yeah, on my chart, Morgan, on my screen, it looks like a little tiny box. Is there a way to click the top icon? Are you guys seeing my screens okay? Okay. A little too loud. Boom, boom, boom. Well, here's one of the things, because this has a very strong Nadex flavor. I wanted to spend a little time today helping you guys understand where we might play a role in your binary option market analyzation. And I honestly believe that we're probably the absolute best tool to help anyone attempting to trade binary options with regards to one particular element, and that is in regards to time. And I found this quote today. Someone who maybe just stumbled on the concept, if they Googled binary options, would find this explanation, and it says, it's an instrument where a prediction is made regarding the price of an asset at a certain time of the day. Prediction, time, prediction, time, prediction, time. And I kept thinking in my head, where have I heard that before? And ironically, I remembered it's the third slide of my PowerPoint presentation. And believe it or not, I'm going to be one of those vendors that actually uses one of those. I don't necessarily believe that's a bad thing. I think when you read and learn from the people who've done things in the past successfully, a PowerPoint presentation can actually be a good thing. And this one quote is the last thing I'm going to show you out of my 60-slide presentation, because quite honestly, I can't really do much in 45 minutes. The average course time for our material is about minimally 4 weeks to 6 months. But I want to just, again, go back to this slide and then roll forward, which is actually backward 100 years. And this man, who was reportedly 85% plus profitable, said this. He said, time is the most important factor when you're looking at the market. And here's what he said to do next. When you study the past, you'll be able to prove for yourself that history does repeat, and that by knowing the past, you can tell the future. Knowing the past, you can tell the future. Binary options are risk financial instruments where a prediction is made regarding the price of an asset at a future time of the day. So logically, I'm looking at this and I'm thinking, well, if I'm going to trade binary options, and this man was 85% profitable, he said to predict where price will be at a future time in the day, I need to study the past records of the averages of the instrument that I'm trading. Does that seem like a logical conclusion? If I choose this route, so I'm looking towards the man who said, I've mastered the study of market prediction. I've mastered the study of market prediction. So I wanted to show you what that means today, but I want to give you a little bit of a background about what it is I'm about to show you before we get there. This chart is taken from the software that we've developed. It doesn't cost $7. But this is a very important answer to a question. This is the very important answer to a question, and the question is simply this. See if it comes up here. Are there any times in this market that repeat? And I believe when we look back on this century and this particular era of trading, there were times when all the great indicators would work. When I first started trading, I started trading because someone told me about Fibonacci. And at the time, that was about 10 years ago, you could get away with trading a 62 fib. And if you waited all day, the market moved about 6 points on the E-mini S&P. You'd get a 4-point pullback and catch a 2-point extension. And it worked. Those days are over, ladies and gentlemen. We live in a universe that is dominated by high-frequency trading. It is dominated by algorithmic trading. It is dominated by high-speed executions. As you and I sit here today, men and women are furiously tunneling, are furiously laying larger and thicker fiber optic cables between the exchanges and the data centers. If we were to go to Manhattan right now and drive 15, 20 minutes to the other side of the bridge in New Jersey is one of the largest data centers connecting the institutions and their algorithms back to the stock exchange. Uncle Larry's indicators don't work anymore. And many of you people here today, as I've read through the comments of your general chat, are saying, I don't rely on these things anymore. And there's a reason for that, because over 50, 60% of the liquidity in the markets, equity derivatives in the UK and US, are from computer trading right now. You're not trading against a person. So when Gann says you should study the past, we take that quite literally, and we use our computer to reverse engineer the question. Are there any times in this market that repeat? Because what did he say? He said, by studying the past records of the individual averages, you will be able to prove that history does repeat. Well, gentlemen, ladies, look at this chart. This is the forecast for the gold market on Monday, Eastern Time. Do you see any times on this screen that the software was able to locate a particular behavior pattern that repeats with any kind of distinctness, with any kind of indication that it might be a move into the future? In essence, if the computer can't find a time where the market makers, where the institutions, where the people who drive this, we use neat little phrases like what? Smart money. I'm following the smart money. What does that mean? It means whatever the guru that you're paying a monthly subscription to at the time tells you at the time. When you look at it through the lens of your computer, remember that thing that you spent a couple grand on? Sitting there by your feet or on your desk, that thing you use to check your email now? Well, this is what it looks like when you take that thing that you dropped a couple grand on and do something powerful with it. And my computer is telling me, Michael, I've analyzed 3,000 bars of data in this market on this time frame. And if I were you, I would be sitting watching what's going on at 8:30 and 8:15 and 7:29, 7:27, 8:29, 10:31, 10:23. Notice these are weird times. You know, you get these wonderful books. Buy my ebook for $749, and he tells you something generic. The market generally trends upward from 10:30 to 2:15. Watch for this important reversal at 11 o'clock. And the software comes back and he says, it's not 11 o'clock, it's 11:13. How many people have seen the difference between a losing trade and a winning trade made by 30 seconds or 60 seconds or 180 seconds difference between their entry and exit. A stop hit, and then the market immediately reverses afterwards as though it's been sitting there waiting for something to happen, and then the something happened. Ladies and gentlemen, this is a visual map. This is a bus schedule of the something that's about to happen. And what can happen here is generally a 60% chance of the market coming down into 830 and reversing and going up. But there's also a 40% chance that the market may go up into 830 and reverse and come down. See what Gann spoke about, and then Wells Wilder later on in the 80s confirmed, is that time cycles are one of the foundational underlying pinnacles of the market. Things happen at certain times. If you go and you analyze any other business in the world, if we sit down and we sit outside of a McDonald's, right? If I sit outside of a McDonald's building and we stare at it with a pair of binoculars, we will notice and write down that certain things happen at what? Certain times. We would notice that the truck arrives to deliver the buns on Tuesday at 2 o'clock. We would notice that the armored car arrives to take the money away at Tuesday at 3:15. We would notice that the truck comes again and delivers the meat on Wednesday at 1:15. Even McDonald's follows routines, but we get to the computer and we say to ourselves, oh, these guys don't have routines. Goldman Sachs, they're just winging it. They're sitting there like me going, oh, this looks like a good place to get in right here. Yeah, I'm going to drop a couple trillion on this crude trade here. I hope it works. That's not how it works. So when I look at this chart, the computer's telling me that there are times in the market, there are moments where certain things happen. And I thought, well, how do I demonstrate that to these guys? Because they're not going to believe a word I say. Well, here's what I did. This is an Apple chart. Remember Apple, those cute commercials on Target television? Steve Jobs hated Google, wore a black sweater and jeans all the time and said things like, it's really cool. Take a look at this stock. Okay? Here's a daily bar of Apple. I want to keep saying Google because I'm a Googleaholic. Now, do you guys notice where I put all these dots? Traders love to draw dots. I love my dots. They're amazing. Look at how pretty these dots are. If you look at all the places that I've put dots, what we have in common here are reversals, are they not? They're places where the market was moving in one direction and then reversing. Right up to this high. Wouldn't you like to have known, if you're an options trader, a Nadex trader, whatever you're trading, you trade baseball cards, whatever you trade, would it have been useful to know whether or not this date right here, 9/22, was going to be a breakout of the bull flag upwards or an absolute crushing blow to Apple the next day? Or for that matter, any of these dates or times. That would have been handy to know. So I say to myself coming into the webinar, how do I prove to these guys what this maniac said 100 years ago? Before the invention of a computer, before the invention of a calculator. When I was a kid, my dad used to have this calculator. He kept it in his armoire. The thing was like half the size of a shoebox, and it had, do you guys remember this? It had the big green Bakelite plastic, and it had the big green numbers on it. It wasn't even LED. It was like those line numbers. And I think he paid like $200 for the thing because it helped him with his taxes. And we weren't allowed to touch it. It was in a leather bag. Well, this was before that. And here's what he said to do. Remember, he said study the past. Okay, so I scrunch up my screen and I say, well, what happened last year on September 22nd? All right, let's draw that on my screen. Because once you understand this, I want to free your minds here today. You know, fibs are great. Moving averages are great. RSI has its place. But we're playing big boy games now. We're playing big boy trading games. And we're learning to think like a machine. If you've ever watched the Terminator movies, you think cyborg. I need you guys to leave here today to start thinking like a machine. A machine that's programmed, much like a Terminator movie, to destroy your account. Right? We never have problems making 2% and 2% and 2%. We all blow up our accounts because we lose 2 plus 4 plus 6 plus 8 plus 10. We always have a wonderful ride on the way up, but we never have a joyous ride on the way down. So when I went back and I looked and I said, well, what happened on September 22nd of last year? I went, oh, wow. Well, that's kind of interesting. Do you guys see what happened on September 22nd of last year? Anybody? What happened? The market collapsed. It was a Casio SIG, you're right. It didn't just go down, it went down far. And I look across and I see all these other dates. September 8th. What did it do on September 7th last year? That was a pivot too, wasn't it? And then what's this date over here? It's October 5th, and I come over here, and there's October 5th, and lo and behold, hey, that was a pivot day too. And then what was this day? This was 727. Well, when was 727? Well, 727 was a pivot over here. Are you starting to see the picture? All of these days in the past are reversal days without any exceptions. And when I come back and I overlay that information on what happened in the future, use Gann's words, not mine. When I come back and I look at what happened in the future, lo and behold, what happened? All of the stuff that happened over here is happening over here as a reversal. Okay, first thing you need to realize if you use this technique. Ready? Number one, go back and find all the pivot days. This is only on a daily chart. Find them. If it's the Eurodollar, if it's corn futures, if it's oil, if it's ETF like GLD or any of these, SSO, go back 1 year, go back 1, go back 2, go back 3. Number 2, identify the day. And then use this general rule of thumb, plus or minus 1 bar. Plus or minus 1 bar. And keep track of it. Number 3, understand this. Most important. Ready? The incoming direction of the cycle does what? The incoming direction of the cycle strongly determines the outgoing direction at that pivot day. Michael, what does that mean by that? It means this. Wells Wilder, when he got a hold of the market delta stuff, which is freaking amazing, can you trade it? That's a whole other story. But when you look at what the charts in the book predicted once you nailed the cycles down, it's mathematically impossible to call it random. And Wells discovered this word, and you'll hear this word used in time cycle circles. Inversion. Inversion is a fancy way of saying upside down. Okay? And if I go back and look at a day, like the 5th over here, and I come back and look at a day like the 5th over here, can you see how it was inverted? On the 5th, to the left side of my screen, the market was coming down into the 5th and reversed up. In the fifth, on the right side of my screen, the market came up into the trend line and reversed. So I want you to always consider that the direction is determined by what? The incoming leg. Which direction is the incoming leg? And that will largely determine the outgoing leg. And you don't have to take my word for this. You can go back and look at the charts yourself. I can't make this up. As a matter of fact, if you're not convinced and you think I'm a charlatan, that's fine. Yeah, Steve will tell you. Wells will even tell you. His critics will say he was a brilliant marketer, but it was very hard to trade. And you've got to kind of devote your life to it to pull the best nuggets out. But, you know, moving forward, look at the dates in the future. You can do this on Apple right now. Everywhere I'm drawing a circle is a date we haven't arrived at. Study them for yourself and see. We don't have time here today. I've got this ominous blue thing on my screen that's going, and I only have so much time with you. But this is kind of the first step I wanted to show you to prove that, you know, Gann was right, but it's impossible to do what he does without spending 6 or 7 years on it. Well, then we have this crazy piece of software, right? And now I have a piece of software that goes out, and what does it do? It says, hey, I'm going to do that for you by hand, and I'm going to look electronically intraday. Most of the traders that we come across, I'd say 75% of them, are taking more than one trade a day, and they're not holding a position overnight. So we kind of retooled the approach and said, well, let's look intraday. Are there patterns that repeat day to day, week to week, market to market? And the software came here and says, yeah, take a look. Well, all of these timestamps are great, but what did they do when we came back and looked after the fact? Well, here's a chart of gold. And I'm going to take a screenshot real quick. And I think I can paste it into this crazy Omnovia thing. How do I get rid of that? Yeah, here we go. And I want you to keep one thing in mind. Everything on this chart, every place you see a red or a green dot, has nothing to do with the price action on the screen. Everything you see on my chart right now in this screencast that I'm about to send out to you guys has nothing to do with the price action on that chart. So let me just draw a couple arrows here. My software said, Michael, be ready at 10 o'clock on the evening of the 18th because I think there's going to be a repetition of a cycle. My software said, Michael, be ready on Sunday night at 11 o'clock for the next leg up. And so on and so forth at each one of these points. And here's the thing that'll blow your mind. I knew about these times 1 week in advance. Not an hour, not a minute. By the way, here's FOMC. Remember that? We're going to support the economy forever. Yeah. This was FOMC. And there's the trade that I took. This trade was based entirely on a forecast. I have no other indicators on my screen other than price action candles and a fat green, it's not easy being green dot. And I said, all right, I'll take a look at that. And guess where I got out? Fire! Big red fat dot right here. And lo and behold, when my software told me, Michael, be ready, there's a red dot coming. It means the market has a tendency to sell off like a you-know-what. I started to see the market consolidating. Okay. Well, what happens when the market consolidates? What do the computers generally do? They have a stop run. They go back and they shake out all the weak sellers, all the weak buyers, and boom, there's the high. They come up and they nail all the poor fellas right there. And guess where I got short? Right after that. And you start to say, I'm going to wait for these guys to shake it out. Take a look on my screen and you'll see something really interesting. Do you notice the stop shakeout right here? Here's the swing low. Here's the shakeout move. Here's the swing high. Here's the shakeout move. Here's where a lot of you guys got stopped out and you said, well, maybe 2% is a little too high. I think I'm going to go back down to 1 or a half. Yeah, half sounds good. Every dot on this chart has nothing to do with price action on the chart. It's based on a forecast from a week before. Let that sink in. So now go back to our PowerPoint presentation that I used 3 slides for, and let's look at what Nadex people are trying to figure out. Where will the Eurodollar be in an hour from now? Where will gold be in 4 hours from now? Will it be higher or lower? Well, the only way to determine that is by studying time patterns. So guess what? If you have a marker that says gold's going to fall down for how long? How long? Right? Isn't that what binary options are all about? How long is this thing going to go? How much rocket's in this thing? If you saw the movie The Matrix, great quote from the Oracle. Everything that has a beginning has what? Has an end. Every cycle has 3 components. It has a beginning component, it has a direction, and it has a termination. It's called a duration. So if you take a look and you say, I don't know, where's gold going to be? Well, we have a beginning, we have a direction, a vector component, and then we have a duration. We have a beginning, we have a direction, and then we have a duration. We have a beginning, we have a direction, and then we have a duration. And you say to yourself, well, I don't know if I can trust it. How often is this thing that accurate? I don't really know you from a hole in the wall. And these are things you should be saying. These are things you should be saying. But the proof of the truth of the matter is that we can strategize some of these things. And we did about 2 years ago. We said, well, what would a strategy look like that was based entirely on what? Time cycles. And we threw it in NinjaTrader's strategy analyzer, and all we did to confirm the dot, was use a Bollinger Band. How great is a Bollinger Band, by the way? How many of you guys, if you had to go to a deserted island with a trading computer and somebody said, you can use only one indicator to trade, you'd say, give me a Bollinger Band, baby. Yeah! You wouldn't, because it's not that great by itself. And all we did was pair it up. We said, hey, Bollinger, I want you to meet time cycle. Time cycle, Bollinger. Hey, how you doing? I'm doing all right. And it came back and it said, hey, 60-70% of the time, the cycles do exactly what we were anticipating them to do. Can you do something dangerous with 70% in this industry? Can you do something dangerous with 65% in this industry? Okay. And we said, well, what does that look like on a graph? We put it on a graph. If time cycles don't exist, this graph shouldn't exist. If time cycles don't exist, this graph shouldn't exist. Okay? Now, I'm running out of time. Let's keep moving. There's not enough time to do all this. So, one of the things that we look at is intermarket fractal patterns. intermarket fractal patterns. And we say to ourselves, is it happening in other markets? What other markets can we look at to determine if this is happening or not? So we look at an ES chart on a 60-minute chart, and guess what? Lo and behold, when everybody's on the phone calling their broker, I'm locked in a position, I can't get out. I was long and I didn't have a stop in, I need to get out. The software was telling you a week ago, get ready for a cycle. Every cycle that has a beginning has an end. Okay? We can apply these same techniques to other markets. And somebody said, hey, I only trade Apple. Can you help me? Yeah. And we start to come in here and we look and we say, well, what percentage of the time is the market actually doing the things that we're anticipating it to do at the cycle times? And we start to say to ourselves, hey, this might be really useful if we trade options. This might be really useful if we have puts and calls to play with, right? And every single one of these cycles is known about a week in advance. And we thought, hey, that was pretty cool. Well, you know, what about an ETF? Every webinar, somebody wants to know, is it going to be different with my instrument? I'm going to show you how your stuff doesn't work on my tool. And I said, okay, great. We'll start looking at it on SSO, which is a double long E-mini S&P. Guess what? Short cycle, long cycle. Short cycle, long cycle, long cycle. Short cycle, short cycle. So this one, no good. So one of the tests of a strategy is how robustly does it perform across multiple time frames, across multiple instruments. So this is a forecast that we'd sent out for crude on a 1-minute chart for last Friday. And then we sent it out to 6,800 people for Thursday. So this is a chart that represents turning times that we had sent out to people, just like this chart in the corner. And I said, hey, come back. Now, of all the markets in the universe, which one would we say is probably the most volatile? Which one is the most unpredictable? Right? If Gann is wrong, this is the market we're going to prove him. Because you and I know some crazy dude gets in a boat with an AK, little dinghy, swims out to the Strait of Hormuz, shoots a couple barrels at the aircraft carrier, price of gold, price of oil, everything goes nuts, right? Well, here we are. We come back into the room 2 days later, and I say, well, let's just draw arrows near all the places that the market came in within 1 bar of the actual high or low of each of these moves. And I just start drawing these arrows. And I start drawing these arrows over all the highs and lows where the market actually came in and did what we were anticipating it to do at those times. And I'm moving from left to right, and people's jaws are opening and hitting their desks as I'm doing this. And I'm saying, how did I give you a turning time 2 days in advance that appear at actual highs and lows like this? How can we predict what crude is going to do with virtually no risk at these times with a direction and a duration like that? And straight up into the close of the market, right? All of these times were based on a forecast that I gave these people 2 days before over here. But more interestingly, what was the time frame? A 1-minute chart. When I leave you guys here today, I want you to leave here with an understanding. Ready? I want you to leave here with an understanding. If you're studying Apple on a daily chart, if you're studying crude on a 1-minute chart, I need you to understand that the markets are not random. And like McDonald's, like any retail store, times a billion, Goldman Sachs, Credit Suisse, JP Morgan, all of these places operate on schedules. They operate around routines. They operate around phone calls, emails, memos, markets opening and closing. Customers need to be paid. Customers' funds need to be injected into the market, and funds need to be balanced, and then more phone calls and more emails. When you use your software, when you use the power of these tools that you've purchased, i.e. your computer, you begin to do what? Look behind the glass curtain that these people have erected and see a completely different universe. A completely different universe where now we can know with reasonable certainty when they're getting ready to dump all that money and when they're getting ready to inject all that money. So now imagine the power psychologically of sitting here and your software is telling you, Michael, 1220, the NASDAQ market on a 5-minute chart is going to launch up into the end of the day. And you're sitting here now, forget fibs, forget your fancy who knows who moving averages, forget your super smooth wackadoodle thing. All you know is that for the last 4 weeks, the last 3 days at this time, your computer is saying, hey Mike, I studied 3,000 bars. And you should watch for a launch here. And guess what happens? You got a hammer candle. Boom. Software kicks in, gives you one of these indicators that we give you. Good sign. Next candle, high. Next candle, closes down. Next candle, inside the range. Next candle, doesn't break the high. Next candle, doesn't break the low. Next candle, doesn't break the high. Next candle, doesn't break the low. Hey, where have we seen this before? There's the stop run. Guess what you're watching down here on the bottom of your charts? What are you using to confirm the move? What are you using to confirm the move? You're using RSI, you're using divergence, you're using volume spread, you're using volume spread analysis, using all that crap, and you're saying the risk on this thing is ridiculous. Use your value area high, your value area low, your point of control. I don't care. If MT Predictor says it's an Elliott wave and it's going to shoot up to a decision point, if Viper Trading Systems sees a trend starting to form, ATW signal clicks off and says there's a sniper signal, I don't care. All you need to know is that 60 to 70% of the time, the market is going to start to trend here, and it's not going to stop until you see what here on the other side. Everything that has a beginning, Neo, has an end. And when you begin to understand that the markets have a schedule, that the markets are orchestrated, and that this candle, this sell-off had nothing to do with the Euro crisis. How could it? If we knew about this turning time on the 19th from the 12th, if this was the point where our computer said, Michael, watch for this move on the 10 o'clock candle 7 days from now, how could this move have anything to do with GDP? How could it have anything to do with the non-farm payroll? How could it have anything to do with anything Bernanke says unless, here's the big ending moment. Ready? Here's the finale. Lean forward in your chair dramatically. Unless the people that generate the news want you to believe that anything can happen anytime. And the reality is 70% of the time it can't. They want you to believe that anything can happen at any time. You know why? Because then you slip your stops. Because then you give even bigger spaces to your stops. Then you slide your targets down and take less profit. When anything can happen on the next bar, you sit there every day at your computer and you overtrade. You take too many trades. You revenge trade. You double down and average in on your trades. Call any broker and ask them, how long does the average trader stay alive? In the last 20 years, the number never changes. The number never changes. Why? Because the people who control the gold, here's the golden rule. The people who control the gold want those people to believe that anything can happen. And the reality is, when we look at chart after chart, if we look at the euro dollar on a 60-minute chart, if we look at Apple on a daily chart, if we go back and we study cotton prices as far back as we can go, look at the euro yen, look at gold, look at crude, look at the Canadian dollar, the information never changes. The fractal pattern of the pattern never changes. And the reality is the markets are not random 60, 70% of the time. Not everything can happen. Now, I don't expect you to believe me. That's why Morgan's put a clip in here, a link to a page that once you sign up will take you to another page. And once you guys sign up on that link, I'm going to, include you in my webinar emails, but next week you're going to get a link to this page. And I'm going to give you forecasts in all of these markets in multiple time frames. And I'm going to say to you, hey, the DAX tomorrow should do this. And I'm going to say to you, hey, the crude market, the gold market should do that. And that's going to hold me accountable to you. See, there's two ways to hold a vendor accountable. Number one, you can say to them, what is the profitability of your model? Does your model have an expectancy? And if the answer is yes, can you show me what the expectancy of that model is? And they should be able to sit down with you and say, yes, we've researched this. We knew you were going to ask that question. But we take it one step further and we say, not only should you hold us accountable to that model, which could fall apart in the future, but I want you to hold me accountable to this forecast, which I can't take back. Right? Once I put this out there in the public domain, I can't take it back. But then you and I come back together. And guess what? We look at what actually happened at those turning times. And we sit there and we review what actually happened at those turning times. And guys, if I can demonstrate to you, like I have for the past 3 weeks to 5,000 people a week, nearly 1,000 customers later, if you're trading Nadex binary options and I can show you that the Canadian dollar was supposed to go up for 4 hours and it did, and we were right 60, 70% of the time, what else is there to talk about? So if you're ready to take that leap, open up your charts. Go back to the old school way of doing things. Analyze stuff by hand. Confirm what I'm telling you is true. Do it in the market that you're trading. Look day to day, week to week. What times are the pivots coming in? And I guarantee you, just like Gann guaranteed you 100 years ago, you will be able to prove for yourself. They're not based on Gann cycles. They're based on what the market always does. There's nothing interjected in this analysis. There's no computer saying, I think it's going to do this, or I think it's going to do that, right? There's software like Vantage Point that does a intermarket analysis using a neural net technique, and it's all black box, and you have no idea. This is the computer saying, Michael, this is what almost always happens and will happen in your market. Okay? So guys, I want to thank you for your time here today. It is an absolute honor and privilege when you figure out something that saves the lives of traders across such a wide range of market instruments and time frames. When you've seen as many families and churches and relationships and accounts blown up as I have, and I don't profess to be a great trader. I'm not going to sit here today and tell you, oh yeah, the worst that can happen is a $150 trade, you lose. I'm going to tell you that my partner and I lost $55,000 in 36 hours, having made it over the course of 3 months. And I hated trading. I walked away from it. I was in a closet crying because I had an appointment in my Outlook calendar to quit my full-time job. I was 3 weeks away from quitting my full-time career. And we lost everything we'd made plus 75% of our principal in 36 hours. That is not my expertise here today. My expertise here today is that we discovered something. When we sat down and said, well, why did that happen? And I hope you guys will take advantage of that. You can do it on your own. You can try by hand, or you can visit us next week. Send me a link. Send me an email. Send me a Skype. You can reach me on an airplane. Whatever you want to do is fine by me. It's been a privilege sharing that with you guys today, and I hope you take everything you hear to heart. These guys have great hearts. They want to share what they know with you. Take advantage of every offer. Throw your email in there. You can unsubscribe. You know how to do that. Stop the spam in your box. So take care. God bless. Remember, trading is a means to an end. It's not an end in and of itself. Try to be involved with things that outlive your life. Get on the floor this weekend. Hug your kids. Roll around on the floor with them.